Good morning and good afternoon to everybody. I want to thank everybody for joining us for an HKA webinar. Today's webinar, as you can see, hopefully everybody can see the slides in front of you. Tax legislation update. This is going to be based on the Green Book, really, and then the information that's come out in the press since the budget. Of course, the budget's big, tall stack of paper, but this is kind of the boiled down version. A lot of resources at the back. Catherine will send all those out after the webinar. We have your email address, so you're just going to get them since you've signed up. If you don't want one, email Catherine and say, hey, don't send me the resources. That's fine. But otherwise, you're going to get one. So we're going to get started here. Two of my partners are going to be joining us on the panel today, Blake Will and Jordan Coolingel. Catherine will be sitting in the background, making sure she's capturing calls and stopping me when we need to ask questions. And then Blake and Jordan will, interrupt me when we need to add a little color, or as we like to say, explain whatever it is that I just explained that didn't make sense. So without Blake, got anything to add with that disclaimer?
Nothing to add, Bill. I think we're good to roll.
All right, we're gonna get started. So looking forward to this. This is a big deal. It's the budget year 2022. As we talked about before, in order to get this budget passed, more than likely they're going to have to go through what they call budget reconciliation. Budget reconciliation is something that can be done once a fiscal year. And when it happens, what it does is it allows the Senate to pass revenue changing tax law with a 51% vote. 100 people in the Senate, so I only need 51 people to vote in favor of it. The Senate is so close, they really can't do this. More than likely can't do this on a party split vote, so that's why they're going to think they have to use budget reconciliation. What's that mean? Well, our fiscal year starts October 1. So they're already starting to work through this. You'll see if you were starting to Google, there's a committee called the Apportionment Committee. It's not the Apportionment Committee. Now I've drawn a complete blank, but there's a committee in the Appropriations Committee in Congress is in charge of approving budgets and stuff as they go out so that they can then go to the House floor and then the Senate floor. Each body of Congress gets their own say, and then they each vote on them, and then they come together and work it out so that they can pass these bills. So it's not a straightforward process. So that's what's going to be starting to happen. It's already starting to happen. There's a lot of information out there. You can already get good information from the Appropriations Committee, what's already gone through. Some of the resource at the back, also there's a Green Book in essence for the Department of Defense. There's a Green Book for the U.S. Treasury. Everybody has their own Green Book after the Treasury kind of does their take on the administration's proposal. Now, just so that when you read it, just to understand that the Green Book is not a bipartisan piece of legislation. It was issued by the administration. So it's going to have their bend on everything and their reasons for doing it. So don't get too bent out of shape if you're on the right side of the spectrum. If you're on the left side of the spectrum, don't think they didn't go far enough. Just take it for what it is as an explanation of what's going to go before Congress, kind of in our language. So that's what the Green Book is. So we're going to talk about four things, really, the definite things that were on the agenda that we expected to be in the proposal, in the budget. We're going to talk about the surprises, things that either are in there or aren't in there that we thought might get in there, and based on everything that came out of Washington prior to the budget. We're going to talk about what this means from a compliance perspective. All this stuff is going to mean something. In each one of these, we're going to talk a little bit about, well, then this is what's going to happen. This is when, what should you do? If we don't cover that to the extent you want to, don't hesitate to ask a question. This is a lot more powerful when we can exchange our ideas. So more of a collaborative event. And then finally, what are the other items? We got some fun items in there too that I hope we get to. It's going to be packed. We hope to get done before the hour runs up. If we get done at 45 minutes, that's great. Hopefully we don't run over. So that's kind of our expectations. We're going to try and keep this going. So without further ado, we'll get started in our very first one, which is what did we expect would be in there? This has been well celebrated. So effective January 1st, 2022, if this budget is passed, there is an increase in the top tax bracket, okay? So we're gonna go right now, the top tax bracket starts around at 37%, around 650,000. What'll happen is the top tax bracket, I'm going to go ahead and go to a spreadsheet real quick. So Blake, can you see the spreadsheet now? Did I do this right?
Yep.
Okay, perfect.
You did it, man.
So the top tax bracket starts now at $518,400. Okay, it's going to start at $509,300. A little bit of a difference. And what that means is we're going to go from a top 37% bracket that goes away. 39.6 comes in. Okay, so my spreadsheet is just built for me to do it. And so what it is if I make $1 million, I'm going to pay $334,427 in tax in 2021. There's nothing in here right now that changes the ordinary income piece. We'll talk about other changes, but ordinary income will be taxed this way. So effective rate of 33.44%. In 2022, if I make the same $1 million, my tax bracket is going to go up a little bit. Now, what's happened is since I shrank this 35% bracket, and I'll highlight that, obviously my effective rate on my low brackets went down just a little bit, meaning that then my total effective rate on the top tax brackets went up a little bit. So on $1 million in 2022, you're going to pay an additional $12,940 in tax. Now, this is really close. If you'll hearken back to May when we first started, coming out with some of these webinars about where the budget was going, this is what's been in there. Okay, so this is exactly what Forbes said it would be. You're going to go from an effective rate of 33 to 30, almost 35, 12,940. Now, the thing to understand is the first $500,000 of your $1 million is at the lower brackets. So when you get to the next 500,000, now, that's when that extra tax piece really starts kicking in. So now if I'm doing $1.5 million, 1 year to the next is 25,000, a doubling, right. So I'm going to pay an extra $25,940. Now in the grand scheme of things, and I don't want to be caustic here, is this is not earth shattering. I don't think we are still in fairly historically low individual income tax brackets. I know that the person that's having to write that check for that extra $26,000 would rather have it still in his front right pocket, but this is not earth shattering stuff. It is what it really is aimed at is really the higher echelon top tax bracket. So it's just going to make a big difference for them. But this is the way the math works. And this is going to be in your resources. So you can drop in you can put your own number right in here. Obviously, if I make less than $500,000 $5 million, if I make less than 500, there's no impact on me, okay, because I'm below the top bracket, okay, at 509,300. I am at the exact same place 1 year to the next, okay? So that's the way kind of to look at this thing. So we're going to keep going on that. So what does this mean, okay? So the thing we ought to think about is if we are in an employment situation where I have income deferral plans, we might want to, and we mentioned this before, you might want to consider opting out of those, because we want to accelerate income into 2021. Yes, this is the second time you've heard me say that. I have not said it very much in this 30-year plus CPA career, but I'm saying it now, is that this is another opportunity to accelerate income, take advantage of what are still lower brackets and not have those higher brackets in the future. Get that taxed at the lower brackets. Now, what else does it mean? Well, if I'm a business, I want to accelerate my cash basis collections. If I'm an accrual basis taxpayer, if I invoice you, it's taxed. Okay. So likewise, we want to make sure that we're invoicing everything that we have the right to invoice by the end of the year to get that income in this year, because whether I'm a small business or a pass-through or a corporation, everything's higher in 2022. So let's accelerate cash basis collections. That's a good one. Reconsider this fixed asset write-off. The American consciousness really steps back and says, I bought something, write it off. It doesn't always work, okay? I mean, sometimes because of the law, it doesn't work effectively. But here what happens is if I buy something today and I write it off today, I'm hurting myself two ways. Right now, there's something called qualified business income, or QBI, for a large cross section of our small businesses. Yes, there are many small businesses that can't use it: attorneys, accountants, financial advisors, et cetera, who have limited access to it or no access to it. But most of our small businesses can get this QBI, and it is a free 20% tax deduction based solely on net income coming off that small business. It's not in this budget. We'll talk about that a little bit, but we don't see that staying very long. Okay, so it's kind of a freebie. It's a phantom thing. It passes through. So by deferring that depreciation into the next years, I increase my free QBI this year. I also get more income into the lower back brackets. And even though it doesn't sound right, it basically saves me cash flow. Because now what did I do? Bought the asset in 2021. And then what did I do? Instead of writing it off, I'm going to push those expenses into 22 when I know I'm at a higher tax bracket. Either a corporation is higher tax bracket, my individual's under a higher tax bracket. I'm actually making more money, more cash flow. So reconsider fixed asset write-offs. If you have questions on how that really impacts you, give us a call. Jordan, Blake, and I would love to help you monetize that so that you can really make a good decision on that. And many of us haven't filed those 2020 tax returns yet. So we have some opportunity here to maybe consider what 2020 write-offs look like. Yes, we may have a little bit higher tax rate, but in the long run, we'll probably have more cash flow in our pocket. So also, let's reconsider how those major business purchases are structured in 21 and 22. That's from both buying a business or just the really big purchases. Once again, are we going to do cost segregation, that kind of stuff? And then once we do that, how should they be structured going forward? Defer your cash basis expenses until 2022. So I keep talking about this cash basis. If I am a small business and I make less than $20 million a year on average in top line gross revenue, I can elect to be a cash basis taxpayer. And what that means is I may invoice my client, but unless I collect on the invoice, I don't have to pay income tax on that revenue. Likewise, I may get a bill from one of my vendors, but if I don't pay the bill, I don't get to take the deduction either. So what we have an opportunity here is that we could defer paying those cash basis expenses, accelerate the cash basis income, bring my taxable net income up to take advantage of lower rates and QBI, and save cash flow, push the expenses into a higher tax bracket year. Those are the kinds of things we can do. Now, I know, we always laugh. A lot of our small businesses, you're sitting here and well, I've got a few invoices. I collected on a few of them. They're in the front drawer. Well, this year, I want you to take them out of the front drawer and get them in the bank. Okay. I don't want you to put them into next year. I want you to get them in the bank this year so we can pay tax on them. It sounds weird, but you're going to save cash flow. It doesn't work for everybody. Okay. So give us a call and let us help you through that. Jordan, anything you want to bring up there?
I do. So I just want to provide a little bit of clarity of, before Bill showed us that spreadsheet where on $1 million of income, it was $12,000 of difference. And now we're talking about accelerating income into current year. You might be thinking, well, is the benefit really there if I can only accelerate $50,000 worth of income? I think the main difference there is before Bill specifically looking at tax brackets that aren't taking into consideration the qualified business income deduction, which we think there's a possibility you're going to lose. So accelerating that income could provide more of a benefit than that chart that Bill was showing before. And I just wanted to highlight that.
Yeah, that's a really good point. This chart this is my taxable income. That's what I'm putting in here. And so this is after the QBI. So definitely, that's a very good comment, Jordan. Good job. All right, so the last one I have is consider accounting method changes. And what we want to do there is, once again, the 2021 tax returns, not all of them have been filed. You may have the opportunity to look at what happened in 2021 so you have tax methods. Every tax return is taking tax methods. The right to immediately expense 100% of a business expense, small fixed asset purchase, became law in 2017. It is built in now to the code. If you don't want to expense it off, you actually have to opt out of that regime and then go back to say 5 year or something like that. And that would be a method change. Some method changes require us to ask the IRS permission. Some of them don't. So if I wanted to go from immediate expensing of fixed assets to makers, which is, under 5, it's 20% in the first year, and then it gets smaller in the next, what would be another 4.5 years, then I would opt out. I don't have to ask the IRS permission for that. If I'm a cash basis taxpayer and I look at the landscape, by the way, I'm amazed at the number of cash basis taxpayers that probably shouldn't be cash basis, because the thing they don't get the benefit of is the expenses that they're paying. And a lot of times their revenue is more plannable. So just think about those things. Give us a call. We'd love to walk through the ones that might make sense to you to do, to help, once again, do that acceleration, get the income up, and take advantage of the lower brackets. And once again, we're talking about going from 37 to 39.6. Okay. And also this QBI. So that's the increase in the top tax bracket. We knew it was going to be in there. And this is what you should be thinking about now. The next one, man, this one is a big one, this capital gain increase. And there's a lot to unpack here, even though this is, one of the lengthier chapters when you get your green book and take a look at it. Man, there's a lot of stuff here. So I want to kind of walk through it here. The first thing is that everybody's been talking about really since it came out was it is effective upon announcement. Now, obviously, it's not really effective until it gets passed by Congress, right? So it has to be passed by both houses of Congress. And then based on passing it, then it is effective almost immediately. So if we think through this, we says, okay, so Bill, this isn't going to probably get done till sometime in October, November, or maybe the end of the year, because we need budget reconciliation. So what's that mean? Well, let's say they pass it on October 30th, and this is one of the things that passes. It's already in effect. You just didn't know it. Okay. And really what most people are saying is because the announcement of the budget came in May, that means that what they'll probably do is capital gains prior to April 28th will be taxed under the old law. Anything May 1 and forward will be taxed on this new law. Okay. So new law is pretty complex, and it hits us in a couple of places. So let's get through it. First of all, it impacts you if your adjusted gross income is greater than $1 million, not capital gain income, not taxable income, adjusted gross income. You're going to see another reference back as we get through this where it references gross income. So the Congress and the administration is picking and choosing which is the one that makes it easiest for guests to get this revenue captured. And they're using adjusted gross income here of greater than $1 million per household. Okay. And so, per person. So if I have 2 people in a household, each person gets $1 million exclusion. If my wife and I have $2 million in capital gain, and it's $2,100,000 between the two of us, that extra 100,000 is impacted by this. Okay. The million is not, the 2 million is not, but we have to have the $1 million per person. So it goes from being, an ordinary rate of 37% in 21, and then theoretically, if it passes, the ordinary rate would then be 39.6 in 2022. But this one is going to impact us in 2021. Now, what does it mean from a gifting perspective? Nothing. I can still gift high basis stock to charities, and not have, it didn't change that law at all. So if I have a stock and let's say my basis is $1,000, but it's worth $1 million, I've got $999,000 worth of capital gain. If I give that to a charity, I get to take a tax deduction for the whole million. I don't have to pick up the capital gain and be impacted by this law. So it's not impacting my gifting to charities at all. Okay. We're going to talk about another law that will impact your gifting to kids or other related individuals. But if I'm giving it to a charity, it's not being impacted at all. And right now, if I give $1 million of high basis stock, I get $1 million tax deduction off of my adjusted gross income. So it works out pretty good that way. What else should we be talking about? So the exemption talked about here is not your personal exemption. It's not your estate exemption. This is a new piece of legislation. So we'll have to start talking about these things in each category. Concerning capital gains and the recognition of ordinary income, you have a $1 million exemption per person for capital gains. Okay. Right now, the estate exemption is still 11.5 million. Somebody,
Bill,
Blake, yeah, go ahead.
that $1 million you were just referencing there, is that the per year for when your income's over $1 million, or have you moved on to the gifting and recognizing a gain on gift?
Yeah, I haven't gone into the recognizing the gain on gift yet. I'm still hung up on if I sell stocks, bonds, land, whatever, and have $1 million of capital gain, that is an annual exclusion per person for your family. So if
Perfect.
Bill and Barbara do $2 million this year and we do $2 million next year, two different exemptions. And that's the way So that's why I was saying it's a little bit crazier than the federal estate exemption, which you use over time, right? Or you can use and take down. No, I get a brand new one every year for this piece of the law. Okay, that's that first section. Okay.
And I don't want to jump ahead, but I wanted to, with the,
Is this a spoiler alert?
Well, I don't know. It might be. If it's effective, after the announcement, which was in theory 3 months ago or whenever April 28th was, you would kind of immediately think, well, shoot, I've missed it. I can't do anything. I can't do anything. Which the short answer might be yes, but the longer answer is we're still in a lower ordinary tax rate this year. So if you know you're going to sell something in the next 6 months, a year, whatever it is, get that done before the end of the year, saving 2.6% if you're over $1 million, or potentially, an installment sale still would, if you can get under that, if that helps you get under the $1 million, there's still things you can do. It's not completely over. I'm sure you had that on your list. I just wanted to throw that out.
It is. And I think those are great elements. That's part of it is just because this has happened, the stock that I sold, and remember it's cumulative. So if I sold 25 different stocks, and I'm already over $1 million in my single person household, what can I do now about something I've already done? Not a lot, but they're still planning. Okay. I can still now make charitable gifts to help bring that back down. There's no question about that. So what has happened between May 1 and July, whatever today is, the 16th, whatever has happened is kind of in the books. Okay, but I can still plan with what is going to happen coming forward. And that's Blake's point. Consider installment sales if I'm doing something that's not obviously of stock, but consider installment sales, considering some high basis stock giving in lieu of instead of giving cash. Let's start thinking about that. So a lot of good things there to Blake's point. And he also introduced
harvesting is even potentially a bigger deal, right? It's already something you should look at towards the end of the year. Or anytime, but it could be bigger. It could pop you right under that just enough.
Yeah. So it's an important element to say, first of all, the ship's not lost. Okay. You still have time to do things. It's the second piece of this we want to talk a little bit about, which is kind of groundbreaking new law stuff. And what it is if I have an asset that's worth whatever it is, let's say it's worth $2 million and my basis in it is $1 million. So it's got $1 million of built-in capital gain. And I put it into, I call it an irrevocable trust for the benefit of someone other than myself. What the new law says is as soon as I make that transfer, okay, that the clock starts ticking and that at the beginning on every 90 years, since I made the transfer before it was effective, now I don't have to pick up the capital gain on it, but if I make that transfer into the irrevocable trust, historically, I don't have to pick up any capital gain on that. Well, the new law is a little bit interesting because now the new law works like this, that if I have $1 million, same exemption, right? In any given year where I've in essence placed it into this trust, it starts this clock ticking. And if within 90 years, if those assets, and now, liquid securities are going to buy and sell throughout that year. This is mainly going to hit us with real property and land and maybe small business ownership, quite frankly, that doesn't have this big changeover, right? It's something we hold on to. Now, that's a little bit different because what's in essence going to happen is the administration beginning in 2031, you see, beginning on 1/1 of 2031, we're going to start having recognition events. Okay. And what that means is if I have an irrevocable trust who has unrealized capital gains in excess of this $1 million per person sitting in this trust, okay, and if I have, the law is not clear, but if I have an irrevocable trust with a single beneficiary, you'd think it'd be $1 million, but if I have an irrevocable trust with 3 beneficiaries, is it then 3 million? I wouldn't be so bold as to say where that law part of the law is going to go. But if I have this trust and it's got $1 million of, let's call it $1,500,000 of unrealized capital gain, beginning in January of 2031, we'll start having recognition events. So if you've got it in there and it's been in there for more than 90 years, going back to 1940, you have to pay capital gains on it. So it's kind of crazy because what it also means is if I pass away beginning in 2031, if I pass away in 2031 and my estate has unrealized capital gains, okay, I will get a step up, but that unrealized capital gains, because my estate will be valued based on fair market value, okay? What'll also happen though is my personal return will pay income tax on what that step up is, okay? And that's important to recognize. Whereas before I would get a step up in basis, allowing me to fund credit shelter trusts or other types of irrevocable trusts, and the assets going in there would get a step up in basis. I wouldn't owe estate tax unless I was over the estate exemption, okay? So here's what's gonna happen is, let's say right now the state exemption is $11,500,000. Let's say when I pass away, I have $10 million of fair market value assets that would be considered, that's my gross estate. Well, for estate tax purposes, there's no tax, no estate tax because the exemption is $11,500,000. But of the 10 million, let's say I've got $2 million of assets that are really unrealized gain, okay? And I haven't done anything with it, and then that second piece of it kind of goes away. But let's say I've got $1 million of $2 million of unrealized gain. Well, I'm going to get an exemption of $1 million against the 2 million on my personal return, but I'm going to pay income tax on the $1 million of unrealized gain. I'm going to pay it at the ordinary rate, in effect, at the date of my death. So it is kind of a double taxation thing. So it'll be interesting to see where this goes. Upon my death, to reiterate, if I have a $10 million estate, and in that $10 million estate are $2 million of unrealized capital gains. When I do the estate return, my estate is 10 million, fair market value, got the step up, no estate tax because the exemption is 11.5 million. But on my final 1040, that unrealized capital gain flows through at 2 million, and I'm taxed on 2 million with an exemption of 1 million, so I pay tax on $1 million at the ordinary rates. Now, what happens to the tax that I paid at $1 million bucks? Let's call that $40,000, okay? I get the deduction on my estate return for that tax paid, not a credit, a deduction. And therein may lie some of that double taxation that really the Constitution says you really shouldn't do. But so it'll be interesting to see where this law comes. The weird thing about this law, if I were going to break it down, is this. Every 90 years, and our trigger date is now going to be 2031, but from 1940 to 2031, that's 90 years. From there on, every 90 years, which would be, I don't know what the next 90 is, 2120, okay, there's another triggering event. So if you have assets that were placed in and had not had a recognition event for 90 years in 21, whatever that is, the next one, 2120, you have to pay capital gains again. And that's what this new law does. And so it's a little confusing, be interesting to see where it goes. Now, what's the planning here? Okay, first thing is it's not impacting anything with my ability to go ahead and get capital gain out of my estate. Yes, I'm going to have a triggering event down the road, but it is down the road. So I'm going to get all that appreciation out of my estate by funding these irrevocable trusts. And right now I can fund dynasty trusts, so it can do generation skipping. So all those things are still relevant, still important to think of. What isn't going to happen is I'm not going to be able to, under this law, be able to put an asset in there and have it permanently miss some sort of tax. Okay. If I think about most of my modern portfolios, they do turn. Okay. It's rare now that I get a stock that I've held for 20 years. It does happen, but it's more rare than it was. So the things that this is going to impact is those second homes or those highly appreciated land holdings that aren't about my house. Okay. So those are things to think about and how we treat them, but still plenty of planning opportunities for capital gains increase. Now, everything is not in this law. So let's make sure we understand that there are a few exemptions, and from there right off the bat, we're going to give an opportunity. So what is exempted from the tax? Well, the personal residence gain. Okay, if I'm still living in my personal residence, I still get the $500,000 exemption, married filing joint, but it's not triggered until I sell it. Okay, so if I've been living in a house for 40 years, for 90 years, which may be a little really rare, and it suddenly comes up, I don't have to, because this one is an exemption. It doesn't happen until I sell the house. Okay, so that's exempted. Now, what else is exempted from this calculation? Tangible personal property. So what does that mean? Well, art and collectibles are considered tangible personal property until you get to some threshold at which the IRS, and I can't tell you what the threshold is, says, no, this is a part of your investment portfolio. So when I look at a broad-based large investment portfolio, and this would be in the multi-millions, I would anticipate, I am probably going to have a large gold, real gold. Okay, I've got bullion sitting in a vault somewhere. I'm probably going to have some art, slicing apart some of these hedge pieces of what a balanced portfolio looks at, and they're now substantial enough to make a difference once you get there. So if I'm holding collectible coins, no capital gain. If I'm holding stacks of gold or enough gold coin, that's a little bit different. So we'll have to be really careful there. If the gold coin is in circulation as an exchangeable in the form of currency, then we have to figure out whether or not this law will hit it, because currency, for the most part, is no gain or loss if it's already in circulation. So there's some nits and gnats in here that'll have to come out of here. But one of the things that immediately comes to mind is if I can invest in art and certain other types of collectibles that I believe will be a harbinger of value, it'll help me get exempted from this large capital gains tax. Jordan, what's going on?
Bill, in my experience, this is an unusual law. So most tax law changes have dealt with effective tax rates. It's dealt with itemized deductions, charity, families, qualified business income, things along those lines. This seems like the first time that they're specifically addressing maybe intergenerational wealth or unrealized gains. And it's such an odd time period, in my opinion, to go 90-year event beginning 1/1/1940. Do you think that they had something specific in mind, or is this is us trying to attempt to get some taxes out of unrealized gains? This is an arbitrary date we set in there.
I really think that two things come with this. One, without impacting or saying they've done something with the federal estate exemption, they've done something with the federal estate exemption. Okay, because you get $11.5 million, but if there's unrealized capital gains in there, we get to tax that. And at 39.6%, that's really close to the 40% estate tax. So without messing with the federal estate exemption, I'm messing with the federal estate exemption. That's the first thing. The second thing is there's a really big part of me that I'm not sweating this law too much. Why? Because it actually starts when this administration won't be in office. And so from there, it looks to me like one of those things that we've done in order to justify. So all budgets must balance. So if you've read any of these, what happens is they say, well, we'll get about this much money from this tax increase and this much money from this tax increase. And then they come down here and say, and then we're going to spend that money, like the permanent child care credit. We're going to spend that money. So this tax and credit, it all has to balance. And I have a feeling that this was put in there to be a revenue raiser to help them with that balancing. And whether or not we actually get to 2031 to have it start being taxed, I think it's probably pretty rare. We may, but I almost, for me, there was a little cynicism there, thinking we're just monkeying with the numbers here. One of the resources we have at the back is the Tax Policy Institute, who actually has a nice grid which shows where the revenue is coming from. This capital gains change, believe it or not, this is actually not a revenue raiser for 2021. Not sure why, except that it gave us this big exemption. Whereas normally, once I get over 400,000 or something in AGI, I'm going to have a higher level of gain. I think they're having to give some of that away in order to get this in there and have it be retroactive. And to stop people from taking advantage of getting it out of their estate, et cetera, pretty quickly. So that tax policy industry will show you that there's not really a lot of revenue being put on this, but it's got to be in there for something. I do think it's I think it's the beginning of something I called a couple of years ago when we looked at the first major legislation of the Trump administration, which was kind of this new, and really the Obama administration really kind of rewrote it. Let's go tax at adjustable gross income, not over taxable income where we can mess with it at AGI, whereas a more of a natural. So I think this is the new kind of tax policy where we're really kind of getting into the numbers. Jordan and I were at a breakfast today hosted by Triad Bank, and it was interesting for him, the economic person was talking about how the data we get now is instantaneously. We know immediately right now how much money we know what yesterday's credit card receipts were. The data is already flowing in. So I think what's happening now is tax policy will continue to be crafted in such a manner to be more laser focused on where they're trying to get the money, and it's making it more difficult, obviously, to plan around. Planning here, though, remember, planning here is still abundant. I can still get it out of the estate. I can still get this stuff out of my estate. Yes, I'll have a triggering event if this holds up, but yes, there will be, but it's going to be out of my estate, allowing me to preserve or avoid federal estate tax. So a lot of stuff good here. Still can make gifts. All that stuff's good. This is a deferral. This big one is going to be not going to happen until 2031. And the other one on over $1 million per taxpayer in the household really probably is going to hit us most in 22, et cetera. So any questions, Blake, Jordan, anything else to add there?
I was just going to throw out, Bill, that it is 12:38. So we've been rolling on these two slides. So yep. Just as we're moving on, I just want to keep you aware of that. So, and I appreciate that. Thank you very much. So the thing to note here is on the next one is net investment income. This kind of rolls into two things. I'm just going to talk about one of the things that didn't show up in the law at the same time as I talk about this. What happens a lot, this is effective January the 1st of 2022 if passed. And what we see a lot of, and Blake and I have actually talked about it a lot, is if I'm an LLC taxed as an S corporation, I don't pay self-employment income tax on my earnings over my salary. If I'm an LLC taxed as a partnership, I pay self-employment tax with this 3.8% on the whole thing. And so why is anybody a partnership? Well, we know that there are reasons. S corps are not the easiest to deal with. S corps are an interesting mechanism when you have debt and a lot of reasons. But this part of the law really attacks that and makes it so that there's really not a great reason to be an S corp, because what happens is if you have ordinary W-2 income from an S corp, from your pass through, then it's treated as though the whole thing is subject to self-employment tax. So if I'm an S corporation in 2021, I'm not paying FICA on all that excess earnings
beginning in 22, if this passes, an S corp is going to pay self-employment tax. So all of the earnings are treated as self-employment income. What'll be interesting to see is, well, then will you get credit for it on your Social Security? So if you go run your Social Security, it tells you your self-employed income or your W-2 income. Am I going to start getting credit for it? It'll be interesting to see if I am, since now I'm paying that tax. The other one to think about here is, if I'm a limited liability company owner and I have a salary from the limited liability company, or if I'm a limited partner in a limited liability partnership and I have a salary from the partnership, the distributions are also treated as self-employed income. So they're also now included in self-employment tax and the net investment income tax. So this is going to be one of those where you say, well, how should I be planning around this? I have to tell you right now, I don't know that this tax is high enough to have me start figuring out how to get around it, especially if I'm a limited partnership or an LLC member and I'm employed. More than likely, my ownership of the LLC or the limited partnership is part of being, the great reason to be an employee of that company in the first place. So let's not go mess with that too much. We may have to refigure what that investment looks like. But right now, this is going to be one of those that is going to raise some decent money. I think it talks about raising an extra $6 billion, if my number is right, in revenue in 21, and then it starts going up a little bit more in 22. In 22, so I think it's 6 billion, then goes higher in 23, but it'll be effective in 2021. So those are the big things to think about there. And just to be aware of, when I'm having someone help me with my taxes in 2022, distributions from LLCs and LPs to people who are W-2 incomes, those distributions are going to be taxed at the self-employment rate, the 3.8%, 2.9% self-employment, 0.9% NIIT. Yeah, go ahead, Blake.
But that's only if you make over 400,000.
That's exactly right.
Gross income.
That's
correct?
exactly right.
Yeah,
Yes,
so
right.
Yes. So right now the net investment income tax doesn't come in on active partnerships and things, just passive stuff, right? Investment. This is saying it's pretty much for every partnership, S corp.
Right.
Everything.
Right. And the important part there too is you got to get over 400,000. Now here we are with gross income, not adjusted gross income. So this is going to be the line on the tax return before I get a deduction for health insurance or some other tax, student loan interest,
which is very interesting.
Yeah.
Because net investment income tax, I believe, is on adjusted gross income right now. I wonder if that might just be like a typo in the thing, because that'd be hard. That'd just be another unnecessary complexity.
Yeah. This is why I don't want to write the computer program. Good luck with that. So, all right. So we're pretty close on net investment income. So we'll keep rolling through here. The next one is going to be, whoops, I missed it. Like-kind exchanges. Effective January the 1st of 2022, you will no longer be able to do a like-kind exchange for the sale, the unrealized gain or loss on a property if in the aggregate, your household, 500,000 per taxpayer or $1 million. So if I sell a piece of property and it's got $1,250,000 in gain, and my wife and I, of course, we're in our household, I cannot do a like-kind exchange. And the gain is due when I actually transfer the property. So I can do a like-kind exchange, but I get no income tax deferral for it. So you can still do like-kind exchanges. Now, of course, why would you? They don't necessarily cost more money, but why mess with it if I have to pay tax on it all? Now what you're looking at is, well, what does this mean? Is this so clearly I should do an installment sale? No. It's the tax on the aggregate gain. So if I've installment saled the entire, say I sell a piece of property for $1,250,000 for $1,500,000 and my gain is $1,250,000 and I do an installment sale, as soon as I sell the property, the whole capital gain is due. I don't get benefit for the installment sale. I think that'll change if this law passes. I think they're going to have to give you, they'll still say, hey, you're in aggregate, you're over the $1 million for your household bill. So you can't do a like-kind exchange. I think that's what they'll do. And then they'll say, Well, technically you transferred half the property in year one, so you're only going to pay capital gains tax on that. And then in year two, if you pay the other half, I think that's what'll happen. But this is kind of a big one. Like-kind exchanges have been a part of our economy for a long time. And I anticipate this is going to put a little bit of a crimp on it. Now, in all fairness, in 2000, I don't remember, in the Bush administration, Bush 2, in his administration, he tweaked like-kind exchanges pretty good to make it so that they were a little bit more legitimate. You couldn't use your CPA who was advising, you couldn't use your banker, you couldn't use your attorney. It had to be up here with a qualified intermediary. So he tweaked those a little bit. So I think it put them down a little bit. But beginning January the 1st of 2022, if you have aggregate gain of 500,000 per taxpayer, you will not be able to do a like-kind exchange and get a deferral. You can do a like-kind exchange, but you're not going to get a deferral. So,
real quick, Bill, I want to ask you two questions, if I could. Actually, one's a statement. So clearly for 21, if you got a big old like-kind exchange you want to get done, you're like, it might hit December, it might hit January. I should be looking at a December, thing. But then for 22, let's say you just can't, right? I'm going to sell it. Can't get everything to work. Do it in 2022. It's if you have let's say you have a property worth $3 million and your basis is $1.2 million. I don't know why I picked weird math. Let's say it's $1.2 million. So your gain's $1.8 million. You do the like-kind exchange. Is $1 million still deferred and the 800 recognized as gain? Because it says gain in excess is recognized.
Yeah, no,
it's not a cliff, is it?
Right. It repeals your ability to do the like-kind exchange at all. And that's what it says. It's a repeal of the like-kind exchange rules for aggregate gains in excess of 500,000 per taxpayer or $1 million married filing joint. Now, Blake, I mean, this is
not law yet, and it's still
this is pretty broad. So yeah, I mean, who knows?
Because that would bring in, let me sell it. You could do the math with whoever I'll sell it for less to be able to do it. Which I would, again, I don't know what's going to actually come through clearly. You would think they're still going to allow at least some of it to happen, but that's clearly if you're doing like a gain that's close to $1 million. Knock that sale price down. There's all the sense in the world if you want to do that 1031. Of course, there's a tipping point there, but
right.
We want to talk about that for sure.
And once again, it's in the aggregate and the way it's defined. Remember, this is a Treasury handbook that's only a page long. The law to write this is probably going to be 200 pages, and so
no doubt.
I would anticipate that one of the fixes will be when you aggregate all your gains is an aggregation of gain by property. And therefore, if that property was less than 500 per taxpayer, $1 million, I can't do a like-kind exchange with that, but I can do it for these other 12. I could see that happening. Or I could see a cliff, like you say, Blake, where, hey, these bottom 5 get me to $1 million. So I could do like-kind exchange for them, but the next one over it, I can't do a like-kind exchange. I think those are all part of this. Which is going to give us obviously some opportunity to plan. As we get closer to November, we're going to know more. But I do think if you have property you're thinking about putting on the market and you have a substantial built-in gain, first of all, the market is hot. The economists we talked to today went through a whole lot of underlying reasons why they anticipate this market to remain hot, and that it's not just because we've pumped $6 trillion of funny money into the economy. Here's the fundamentals as to why we think this is going to continue to be pretty good market for a while. And I talked to some home builders in Texas and on the East Coast, large home builders that are doing large, substantial tracts. They see the same thing. Millennials are buying homes. Most of the experts said millennials are going to live next to the downtown areas. They're going to rent, et cetera. Nope, millennials are buying homes, and there's a lot more of them out there right now than baby boomers. In fact, part of the problem is baby boomers are still living in their houses. They're not moving out, meaning there's no inventory. So all those things make this a planning opportunity. If you have questions, give us a call. Okay. Don't ignore this. Don't anything I say. If you have questions, please give us a call. We want to make sure we get those questions answered. So watching the time, 10 minutes. Let's get into some surprises. Don't worry about limiting your itemized deductions. Write those charitable contribution checks. Don't worry about your interest expense being limited. under anything 2017 has not changed whatsoever. So don't worry about that. The QBI, continue to consider the impact of qualified business income on your small business pass-throughs. It's a lot of money. It's a free tax deduction. So stretching out some of those expense write-offs are worth it, especially because we do think sooner or later they shut that down. The adjusted Social Security tax ceiling, and they spent a lot of time on telling us that over 400,000 you're going to get. So between 225 and 400, you wouldn't have Social Security tax, but over 400 it was going to come back in. It's not in here. Okay, so don't worry about that. And the estate exemption. Well, let's continue to plan. Right now, there's nothing in here about the estate exemption. Janet Yellen said in February of this year, which was then walked back, but it looks pretty prophetic. In February of this year, Janet Yellen said that the administration would not be messing with the estate exemption until 2022. So we got a lot of good time here to get this thing going. So if these things aren't in there, then look at charitable stacking, okay? And why would I charitable stack? Because we think that itemized deduction limit's coming in. So let's get the big bonus out of those charitables this year. A charitable lead trust makes all the sense in the world. Why? Because I put the money into the trust, I get the deduction for all 4 or 5 years, however long the trust runs, up front, and then I push it off in the future. So all those things make good sense, especially if I believe the 28% will come in. Small business S-corp conversion still works. I mean, you still got a lot of research. That doesn't necessarily, it's not just a lay down. You got to go do the research. You have to understand how it impacts your business or how you need to structure it. But more than likely, 1 year is better than none. So we'll see how that works. And then finally, I've already mentioned estate planning, a lot of good estate planning still to be done. So compliance, the one thing that really hit me in the face, there were two big things here, and I am watching the time, so 9 minutes, is more than ever. When we talk about what you're doing, I want you to consider those options we're putting in front of you and understand that they're planning on doubling and tripling the number of computer audits and doubling the number of face-to-face, the big audits. Okay, so document retention. If I'm having a conversation and we say, I think you ought to document what you've done here, now let's make sure we document what we think we've done here. Let's put it somewhere where we know it is. So let's make sure we're doing that. Required electronic filing. It's going to be harder and harder for you to opt out to electronic filing. It just is. Okay, electronic filing, especially 1040s, if you make over 400,000 of gross income, not AGI, not taxable, gross income, then you will have to electronic file. If you have a partnership with more than 10 partners, you will have to electronic file. And any corporate return prepared by a preparer who prepares 10 or more corporate returns, which doesn't make sense to me why you would do that. Anyway, all those would have to electronically file. There is a thing on listed transactions. The reason I brought this up is a listed transaction is something that the IRS says, we think this is a tax shelter. And if you do this, you have to disclose to us that you've done it so we can double check that it's an approved tax shelter. The problem I have with this part of the law is that now that if it passes, they'll be able to charge the shareholder for the tax liability if the listed transaction is actually, it is really a bad transaction. It really is. They'll charge the shareholder, not the corporation. So I find that interesting that they're really piercing that corporate veil to go after the shareholder. Blake, you're getting ready to say something.
Yeah, I just wanted to go back to the IRS funding the audits. You know, when I talk to people every day about, you know, I'm just tracking my business expenses, I'm using my credit card statement, or I'm getting close enough with an estimate. You know, I know my cell phone is $100 a month. I'm just going to go with $1,200, stuff like that, which is fine. It's your tax return, right? You know, there's a risk reward to spending the time. In the past, I just finished an audit yesterday with somebody, but we get 1 or 2 a year max. And I've said this for a lot. I've used to knock on wood. Now it's just there are not a lot of audits. Get a lot of notices, computer generated notices, but true audits, we don't get a ton. In theory, as this goes, that's going to change. Does that mean we now get 10 a year, 100 a year? We don't know. Probably on the lower end, honestly, if history shows anything. But it just makes it to where a lot of our clients are high income earners, complex tax returns. You already were on the radar. Now you're more on the radar. An audit, while we'd handle it for you, make it as easy as possible. If you have all your receipts and documents, we can put it all together, make it easy for the IRS. If you don't, it's going to be even more of a pain. So it's a bigger deal. I'm going to start harping on it more. We can help you with the processes. You guys talk about getting processes in place. It's usually not worth the taxpayer's time to, what about your assistant? How can we help? We get some technology, get going, that sort of thing. It should become a bigger deal as we go.
Yeah. No, I agree with that. I think, we talk a lot about it, HK. We talk a lot about the optics of a return. I think optics are become more and more important. There's a large technological upgrade that's included in this budget. Quite frankly, I think it's necessary. I'm not sure I like weaponizing the IRS, but I do believe that the IRS should be standing for for the U.S. taxpayer to make sure that we're all doing what we're supposed to do. And I know, just like my clients on this phone call, nothing angers me more than to get a tax return and go, really, you've been getting away with this for a long time? So you got to take the good with the bad there. But yes, it's time to really get serious about, here's this, make sure I've saved it. How do we save it? So nothing else here unless Jordan or Blake, you have anything else?
I think we're good. 5 minutes.
I don't want to.
last
Yeah, I don't want
to.
to cliff this thing, but oil and gas partnerships. Basically this entire budget is about getting rid of fossil fuels. The whole thing is not the whole thing, but there's a big section on it. We didn't really cover much of it, but if this budget is passed, you are going to need to reevaluate how the oil and gas partnership fits into your overall investment portfolio, as will you need to look at, your other stocks, because we've got corporate tax rates are going from 21 to 28%. I don't know how that's going to impact things, but I do think because oil and gas partnerships over the years and publicly traded partnerships have all become have become really a part of everybody's investment portfolio, you're going to be looking at those a little bit differently. There are some investment opportunities. This first one here, heavy truck zero emission credits. I cannot wait to buy a fully electric F-250. I am chomping at the bit. Ford's coming out with their fully electric 150 by the end of 2022. If they can do this, we know that Rivian has sold 100,000 trucks to Amazon. Peterbilt, the largest truck builder in the world, is already selling fully electric Freightliners in Europe. So it's going to come, and this zero emission credit is a big thing. One of the things that's kind of under the radar is only $2 billion set to the neighborhood home investment tax credit. First time the federal government is going to help subsidize private home ownership. So not multifamily renter stuff, helping small families actually start building equity in their residence instead of having that equity go over to the person who owns those big things. So I love that part of the plan. The electric vehicle charging unit tax, in Great Britain right now, you cannot build new home or renovate substantially new home without also putting an electric vehicle charging station somewhere at the house, which makes no sense because everybody in Britain, parks on the street. But however they do it, I think this is a good one as well. So these are some investment opportunities to be aware of. It kind of gives us a view into where the future is going with some of this industry. It's something to think about coming forward. Our resources. Once again, Catherine's going to send these to you, so you don't have to email her. She's going to send you, if you don't want it going, or if you registered with an email address and you're not going to get it, yes, send us the email address where you want these resources to be sent. The last things we have is the next webinar is on purposeful budgeting. And I wanted to not cliff this thing, but I'm 2 minutes away. Blake, final thoughts.
I think the key is, we're still in the infancy of what really will hit. So definitely don't freak out, one way or the other. But we'd love to talk to you about, how this could impact you. What can you do that just makes sense anyway? Do it now. Yeah. As we know more, we'll have more of these. We'll probably know more what you think, late August to September, October, clearly, as it really clearly this is going to pass type stuff. We'd love to have everybody back on those.
Yeah, absolutely. Jordan, I want to make sure everybody met Jordan. Jordan is a new limited partner, not new, but he's been a limited partner for a couple of years at HKA, and finding his voice. You're going to see more and more of him as he continues to grow in that leadership. So Jordan, thanks for joining us today. Any final thoughts from you?
I actually had a final question for you. So I think as we change the administrations, the tax law changes, and you've seen a decent amount of those changes at this point. I'm not calling you old, but I am implying it. Like, what are your thoughts in terms of the severity of this versus what we've seen historically? I know this is just a proposal, so maybe this is even more on the extreme side, but just curious about your thoughts with that.
I think it's an interesting thing. And in the backdrop of the meeting we had this morning, Jordan joined me for breakfast at this Triad Bank seminar. And the backdrop was that, the government has been printing money. Okay, we're off the gold standard. So we're printing money. And pretty much everybody's like, that's got to get inflationary at some point in time. What I found fascinating was when you show the chart of inflation over the last 15 years, what the Fed is saying is we have some inflation that we are earned that we can get back into. And so, yeah, it's going to be inflationary. I believe that these are major revenue raisers. I think the rest, it's going to be your personal preference on this. But he also said was what they found is, if I take money out of the capital acquisition sector, which is where as we raise taxes, it's coming out of the hands of people that invest in the capital. When we take it out of that and then plug it into the labor market, the economy continues to hum around. So it's going to look pretty interesting to see where we go. And as he said, I agree with him. It's really too early to tell. We'll see how resilient the economy is. And then how things go as this budget goes through Congress. So thank you for everyone who joined us. We got a little bit long. I appreciate it hanging in there with us. This is recorded, so you'll be able to find it somewhere on the website. Let us know if you have any questions, as we mentioned before. We'd love to help you. Thank you now. Have a great weekend.